You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. Okay guys, welcome back to yet another episode. Episode number 93.
92.
92, 93, 92.
Is it?
Probably. Yeah, 92. That's classic Brandon, isn't it? Just trying to say what number it is and having no idea what we're up to. But that's pretty exciting because we're only a few episodes away from number 100.
Yeah, we're almost
Get around us.
We're almost there. Almost there. 8 more weeks if we're consistent with it.
Yeah.
Which
I think how we've been saying we got to do something big for the 100. To be honest, I don't even know if we're going to be able to.
Oh, not currently what's happening. 2 months
we
out.
Might have to.
Yeah.
I don't know. We should do something though. If you got any ideas, let us know. But maybe people could send in video messages or video questions, and we could splice them in or something like that. I don't know.
Yeah, that's a good idea actually. Yeah, absolutely. Just let us know in the YouTube comment section what sort of, if you've got any ideas for us, because we're not going to be able to. I don't think at all we're going to be able to do our typical meet up and do a live podcast, unfortunately.
Just don't think it's going to happen. Yeah, you being in Victoria, geez.
Yeah,
stay away.
Yeah, don't come anywhere near us.
Speaking of which, how are you doing down there? How's life in the Badlands?
Pretty good. I mean, same as the last few weeks. Not much to report on. Nothing too exciting happening here. But
clearly.
How's Canberra going?
Canberra's great. Just gonna again rub it in. But nice day. I was outside. I went to the shops, went for a walk, hang out with my friends, it was great. It's really good. No restrictions, no active COVID cases, life's good, life's good. Actually, I tell you what, I saw Nick Kyrgios at the shops the other day.
Oh, wow. Nice.
Yeah.
What's he?
Because he lives in Canberra.
Oh, does he?
His family's from Canberra.
Right.
I saw him, he was just getting in. I actually didn't recognize him. I recognized his car first because he has a Dodge Hellcat.
Oh, okay.
Very distinctive American muscle car that really not a lot. I've never seen another one besides his. But yeah, I saw his car and I was like, hey, that's Nick Kyrgios's car. And then sure enough, there he was. But there you go.
Yeah.
That's my little interesting story of the week.
One other thing to mention, guys, we are recording this in the afternoon today. And historically, when we've recorded these in the afternoon, we haven't been on our best game. we always
historically we suck at recording podcasts in the afternoon.
Yeah, I was trying to work around not saying that directly, but
well, I said it directly.
Yeah, there you go. So we'll do our best to.
I mean, there was one time we recorded in the afternoon and we basically just fell asleep talking, and then whenever we do, we just can't keep on track. I mean, right now, what the hell are we talking about? Nick Kyrgios doesn't have anything to do with investing or business. Let's be real. He's certainly got a lot to do with money though, because I imagine he's got a lot of cash.
Yeah, that's
those
for sure.
Tennis players, man, that prize money. I remember we covered that when the Australian Open was going on. Remember that episode? We talked about the prize money. Yeah, that was a long time ago. But man, they get well paid even if they get knocked out in the first round. It's crazy.
Yeah, they make a lot. Yeah.
They do make a lot. Certainly a lot more than you or I.
And with that said, let's get into today's sponsor. So today's episode is sponsored by Sharesight. So Sharesight is an application that you can use to track the performance of your stock portfolio. And it's fantastic for keeping track of your capital gains, dividends. If you have dividend reinvestment plans, then it will do all of those calculations for you. Currency gains, if you're buying shares internationally or you hold foreign currencies. And then the main reason why I personally use it is for when it comes to tax time. So Sharesight generates up to 10 different reports that can be used at tax time to easily work out things such as your capital gains, dividend income, and more. And you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. And if you use that link, you can also get 4 months free when you sign up to a yearly subscription. So help us get up to Nick Kyrgios's pay.
Yep.
By using that
I think
referral
if
link.
everyone in Australia uses our referral code, then we might be half as rich as Nick Kyrgios.
There we go. That's our goal for this episode.
That's our goal. Yeah. Our goal. That's a big goal, to get the whole of Australia to use our referral code. 24 million people? I mean, everyone should have Sharesight. Let's be real.
Yeah.
Let's be real. Everyone should have it. It'll save you a lot of time. Tax time will be a breeze. You just print out the document, hand it to your accountant, or plug it into your tax return. Am I selling it enough?
Perfect.
Anyway, let's get into the news. Man, what a just slow week of news. Sorry to just bring down the energy for a little bit, but
and half the listeners are gone.
they're gone. They've turned off. So, of course, in a slow news week, what do? We turn over to what's going on with good old Elon Musk.
Yeah, back to basics. Tesla news.
I saw... Yeah, exactly. Yeah. Young Investors Podcast 101. Just talk about Elon Musk and Tesla news. Anyway, I saw this pop up. You know how it was only a couple of weeks ago we were reporting that Elon Musk is quickly moving up the rankings of the world's richest, and he got to 4th richest. That was only literally like a couple of weeks ago. Well, now he has overtaken the Zuckman. Ooh. Big Zuckerberg himself. So Elon slots into 3rd richest in the whole world. Down you go, Zuck.
It's just insane. I don't think Elon likes Zuckerberg very much, so he'll probably be happy about that.
Probably not.
About that.
Well, he doesn't use he uses Twitter. He used to have an Instagram. He's never used Facebook, and he shut down his Instagram. So
there you go.
Yeah, I probably imagine he's not a huge fan of the Facebook products, I guess.
Yeah, it's just insane. I had a quick look at, I don't really keep up with Tesla's share price that much, but I couldn't resist having a look, and I had a look at the market cap, and they're over 400 billion.
It's bonkers.
In market cap now. I remember not very long ago, they might have been like 50. And
they split their stock and they went up like 12-13% or something in like the day after they split their stock. It was crazy.
Which doesn't really make any sense.
It doesn't make sense. Splitting stock, when you think about it, splitting stock only matters for retail investors. And retail investors are like 20% of the market. I think I've spoken about this before, but you know, even if Tesla's share price is $2,500, I mean, 80% of their stock plus is probably held by, all the, investment banks and whatever, all the different funds of the world. And they've got so much flipping money at their disposal that they can buy, like they're trying to put in $10 million, $100 million stake into Tesla. I mean, it doesn't matter if the share price is 2,000 or 200 for them. But
I mean, I've seen a lot of people make that argument that, it should go up because, it goes from 2,000 to whatever it is, $450 or $500 per share, and therefore more people can access it. It's more accessible. But surely that's not to much extent. There can't be many people who would not make an investment in a company because they have to put in 2,000 instead of 500. I could not imagine that being more than a very, very small percentage of
it'd be a tiny amount.
Even retail investors, that would not make a substantial difference for the majority, I would say at least. But maybe I'm naive, but And
I'm saying like 20% of the shares of a company might be held by retail investors, but that's not even the number we're looking at. We're looking at retail investors that are looking at buying Tesla right now. That's the subset. That's the subset we're looking at. And how many people can that realistically be? Not how many people. How many dollars can that realistically be?
Yeah, that's the right way to look at it. Yeah, absolutely. Yeah. Because even if there's a large amount of people, the substantial majority of people investing in, as you said, the substantial majority of people investing in Tesla are institutions that are.
Yeah, exactly.
That this isn't any problem for at all.
So it doesn't make sense, but there you go. But that doesn't stop Tesla. I'm just charging up, charging. I'm loving it. I'm loving it.
I'm
Actually,
sure you are.
I'm loving it, but I'm also like a little bit frustrated because I sold half my stake at 800 because back then it was going up like 10-15% each day. And I was like, whoa, this is classic bubble territory. So I did sell. I sold half my position, but clearly that was the wrong move. But I've got a mate of mine that doesn't pay as close attention to investing that I do. And he just dumped, I think, $5,000 into the stock maybe a year or two ago, maybe a year. I don't know. His average buy is like 240, I think.
Wow.
And he's just kind of held on through everything. So I feel a little bit jealous now because I think he's turned 5,000 Australian dollars into like 30,000 US dollars or something crazy like that. I mean, that's just bonkers.
Yeah, you have one of those investments every now and then, and you're sweet.
Yeah, so he's cheering. He is absolutely cheering.
Oh, that's brilliant.
But good on you, Matt. If you're listening to this, good on you, mate.
Good on you, Matt.
Good on you, Matt. Hamish approves as well.
Anyway, we had some other news out of Tesla as well.
Yeah, I'll let you run.
I'm not
through
exactly
this,
sure when this happened in the last couple of days, I think.
Yeah, it's recent.
But yeah, so Tesla also announced that they're raising $5 billion worth of stock. So they're going to be basically selling a bunch more of the shares. They're basically creating shares in this process, selling them to the open market, and raising $5 billion, which I think I read an article that said this was the biggest share raising at a single time in history. Right. I think I read somewhere that was, someone fact checked me on that, but I'm pretty sure I read that.
But it's kind of smart. I mean, because they wouldn't have to sell too many shares. They wouldn't have to dilute existing shareholders very much at all to be able to do that because their share price is so high, even with the split, because the split doesn't actually change anything.
Yeah.
Yeah, it's crazy.
Yeah, exactly. The way that I think Warren Buffett has sort of described the process when a business decides to either buy back stock and delete shares or to raise capital is, if you're buying back stock, you want the share price to be undervalued. And if a company is selling more shares, issuing more shares, diluting the shareholders, it is really a good idea if the management team basically believes that the stock is overvalued. I mean the way that I like to think about it is, the existing shareholders are basically trading a part of their percentage ownership in exchange for the business getting some cash so that they can make some investments. So it's kind of like, my whatever amount I'm about to get reduced by my percentage ownership, whether that goes down from like 1% to like 0.98% or whatever, am I happy to take that reduction in exchange for the business now having $5 billion to invest in some growth? Or in this case, I think Elon just said that it's going to be used to strengthen their balance sheet. So a little bit more of added protection while we're going through the current recession that we're in. So yeah, very interesting. I think.
Yeah, and I just saw, like, for the Tesla example, I just looked up the original plans for how much the first Gigafactory was going to cost them to build, and that ended up being $5 billion. So, I mean, for a Tesla shareholder, going along that same line of thinking, that same example you were just talking about, it's like, am I going to cop X% dilution for them to have an extra $5 billion, which could literally get them another Gigafactory, which could pump out, X amount of cars and make X amount of sales revenue for them each year. And you might look at that and say, actually, I tell you what, I'll take the dilution because it's going to mean that their revenue is going to go up by X billion dollars next year. And that's going to be good for me.
Yeah, absolutely. So a smaller percentage of a bigger pie, ultimately, if that $5 billion, investment goes and grows in the future. But I think you can tell that Elon's pretty smart about this, because the last time, I'm not sure exactly when it was, but the last time that they sold some more shares, raised shares, it was around when the stock was about 800, right? And it had just...
Yeah, it's when it ran up real quick. Really when quickly. I thought about selling, Yeah, and I mean, that's exactly what you want to see. I think you see far too often, you see a management team where they're just they're constantly raising shares and diluting, or they're
they're constantly buying back stock regardless of what the stock price is, rather than every now and then you see a management team that does it quite strategically, where they're only buying back stock when the stock has fallen because of some kind of short-term problem, or they're only issuing shares when the stock has gone up a ton and maybe at a price that's unsustainable in the short term. So it's a good opportunity to generate some cash flow for the business. So yeah, very interesting.
They're the types of management teams that I like.
Yeah, absolutely. And
that don't just do it for the sake of doing it.
Yeah.
It's like, Apple just buying back stock for the sake of it. Yes, they got a ton of money that they can do it with, but I kind of like it to be at least slightly strategic and really put your shareholders in the best possible place you can. But is that where we should leave the Tesla talk for today? Is there anything else to cover on that?
No, I think that's just about it. We did have a comment on one of our podcasts saying that because of all of the news happening around Tesla, it's time for another dedicated Tesla podcast, but I don't think quite yet. We'll
I reckon, because I tell you what, that battery investor day, actually their annual shareholder meeting and their battery day are now happening on the same day. So I reckon there'd be enough content to do a big maybe Tesla episode. I think after that date, I think it's September the 22nd or something like that. So I don't know, maybe.
So it's coming.
I feel like battery day is just going to blow my head off. It's just going to be crazy.
Yeah, when is that? When?
I think September 22nd.
Okay, all right.
Yeah,
so pretty
I think
soon.
It's close. Yeah, a few weeks away.
Right. Okay.
I think. So yeah, we'll keep tabs on that.
Yeah.
All right, let's move on. Warren Buffett. Here's another person that we like to talk about a lot. I got to be honest, I was having a look at, he's been doing some buying and I didn't fully understand exactly what the whole strategy was. It didn't quite make sense in my head. I think that's just because I don't know so much about the Japanese market. But the story is that Berkshire Hathaway, through one of their smaller businesses, what's it called? National Indemnity Insurance, something like that.
Yeah.
They spent about $6 billion buying positions in Japan's 5 largest trading companies, which is interesting.
Yeah.
Do you know much about this? Have you? I noticed you did a video on it.
Yeah. So on Monday I was looking for I was struggling to think of a video topic, and then this news article came out, so I jumped on it.
Boom.
It's always good when that happens, when something big comes out, especially around a big investor. Yeah. So I made a video on it. It was very early, so it was kind of more of just an update around what was happening. But so they invested into 5 companies and they purchased 5% of each of their shares, and a number of articles are saying that it was a $6 billion investment. And I spoke about that in my video, but they didn't actually say how much they had invested.
Oh, didn't they?
They just said that they had purchased 5% of each of those companies. And then I'm guessing...
So maybe someone's gone and done the maths on it.
Yeah, someone's just done a little bit of an approximate. But honestly, the share prices of some of these companies has bounced around a lot over the past 12 months. Some of them have been down 70% here, 40% there, up and down. So I guess we don't really know. But I mean, maybe $6 billion is a good estimation. But I can give you an attempt to pronounce some of these names, but
let's hear it. If we've got any Japanese speaking listeners, I want you to jump over to the YouTube version of the podcast and rate Hamish's pronunciation out of 10.
Yeah, rate me out of 10. I think I've got this first one, Mitsubishi.
I'm pretty sure. Pretty sure that one. Unless the way we say it is different to the way it's said over.
It probably is, honestly.
It's actually Mitsubishi.
Yeah.
Mitsub.
So there's Aitoshu, Marubeni.
Yeah, okay.
Mitsu, I don't know, that one. And Sumitomo. There you go.
Itoshu, Marubeni, Mitsubishi, Mitsui, Sumitomo. I don't know either.
Yeah. I don't know how to pronounce that UI. So,
sorry?
I don't know how to pronounce the UI at the end of Mitsu. It's probably a pronunciation for that. Anyway, you can rate us both.
Yeah, go for it.
1 out of 10.
But as I understand, so these these trading companies, I mean, I didn't really understand what these companies do, but it sounds like they're kind of like, another term might be like conglomerates, I suppose.
Correct. Yeah. So it's just another term for conglomerate.
Right. So they have, business in various different sub businesses across multiple different industries, kind of what like Berkshire Hathaway already is. Is that kind of a fair approximation?
Yeah. Pretty much. I mean, most of these, I had a brief look at some of their businesses. Like most of them have businesses in a vast number of industries. So like textiles, food, energy, materials, commodities. So, and that's just one business has each of those industries within it. So they're really widely diversified. However, there was a couple of them, I can't remember off the top of my head, but a couple of them were very concentrated in energy, which lines up with some of Berkshire's other businesses. So even though they're in a lot of industries, he's probably looking at these ones because they have a higher concentration in the areas that he's also invested in the past. Okay. So areas that he understands. Yeah.
Yeah. And as I understand, these companies are not only kind of they don't only have kind of Japanese-based business, but they also have a lot of kind of international business agreements and deals. And it's not like you're just buying into the top 5, conglomerates of Japan that are all Japanese-based business. It seems like there's a lot of international exposure there as well. And I also understand that these 5 companies are quite a backbone to the Japanese economy as well, that's just what I understand after doing a little bit of listening to different YouTube videos and having a quick read of some different articles. So I find this really interesting, but I actually just got off a call with Investing with Tom, and that's actually going to be a video that comes out tomorrow. So if you guys are listening to this on Saturday or beyond, then the video is already out on my channel. He was saying something that he found really interesting is that in 2019, Warren Buffett, Berkshire Hathaway, they actually sold about $4 billion worth of bonds, which is like 620 something billion yen, I think. So these Japanese bonds, they sold them because they could get, they sold mostly 10-year bonds at like a 0.4% rate, which is just crazy. So they were raising this money really, really cheap. And what we kind of came to in that video is that we think that it could have been the case that Berkshire Hathaway just bought sold all these bonds, raised that capital, and then put that money into these 5 big diversified conglomerates, because it's almost like an arbitrage because all these 5 businesses have, I think you spoke about this in your video a little bit as well, they have like juicy dividend yields, 3, 4, 5, 6%. And there's been times where, all of these companies have been PE under 10 or something like that. I think all but one of them has like a PE under 10.
Yeah.
So that again makes them, relatively speaking, makes them cheap and kind of de-risk the investment. So it almost kind of looks like a bit of this arbitrage play where Berkshire Hathaway's raised this money really, really cheaply and then have just sunk it into something that's basically, even if the stock goes nowhere, they're still going to get like 5, 6% dividend yield. So they might be just printing money straight away.
Yeah, the thing is, if you can borrow money that cheap at 0.4% and you can manage the debt, which, Berkshire is loaded with cash at the moment. So, taking on a little bit of debt, $4 billion in debt, is, it's not something that they can't manage. If they can do that, then it absolutely makes sense to take advantage of that and then try and, use that debt in order to invest in businesses. But in terms of just a strict, classic valuation standpoint, most of them had at least a free cash flow yield of about 15%. So that's basically a price to free cash flow of about 6. So very, very low. I think all of them were below a book value of 1, or some were just below 1 and some were just above 1.
Cheap.
So based on like last year's earnings and their assets, very, very cheap. Of course, that you need to think about, what the cash flows are going to look like in the future. But considering they're very, very large, highly diversified companies, they're probably in a situation where I'm guessing their cash flows probably won't change too much over time.
Probably not.
Just because they're invested in so many different industries.
They're so diversified.
Yeah. And these companies,
and then,
these companies are huge. All 5 of them are in the top 25 businesses in terms of revenue in Japan. And all of them are also in the 500 largest global companies. So very, very large companies, not only just in Japan, but also globally speaking.
Right. So Buffett's saying, look, pretty low risk of failure. The stock's already very cheap. The cash flows are looking juicy. He obviously likes to look at the cash flows, and he's just saying, you know what, this makes a lot of sense. You know, it's diversified. They should be stable revenues, you know. So why not? If I can borrow money that cheap, and I can even if the stock doesn't go anywhere and I just collect dividends, I should still be in the black, which is good for him.
Yeah, pretty much.
I guess that's an interesting story.
Yeah, and
I wish I knew a bit more about Japan. To be honest, I just don't.
Yeah, I mean that's the thing. I don't. That one thing. The first thing is don't know much about Japan, and the second thing is these businesses are not a simple business to just look at.
No, and good luck trying to understand them.
Yeah, the simplest way to just look at them is is what everyone is saying, that they're just trading companies. They're a conglomerate.
Imagine Google translating their annual report.
Oh no.
That'd be so hard.
Oh no.
I imagine they just report in Japanese. So.
Well, they do report in English as well.
Do they? Okay.
At least the one that I read was in English.
Oh, cool.
Unless I can read Japanese, and I don't know it.
You didn't know it. You're like Harry Potter. What's that thing in that movie? He can like talk to snakes or something, and he just thinks he's talking English or something.
Yeah, that's it. No, but I mean, all the currencies in all the currency was in yen, which was a little bit annoying. Even just for making the video, having to do conversions just to wrap my head around what size these businesses were. So, I mean, what I said in my video was basically. I mean, there's certainly good opportunities in these markets where there's less people looking. But when you're getting started, there is just that added level of complexity when looking at businesses like that. Even simple things like having to do the currency conversions. It's just another thing that you could make a mistake on. That if you're just getting started, it's probably best to stick to businesses in the market that you either live in or the US market. So that's what I said in the video anyway. But cool. The only other news in relation to that was that so they bought 5% of each of those businesses, and they said that they may increase that or they can increase that to 9.9% ownership of any of those businesses. So basically they could double the size of that investment.
Right. Okay. Yeah. Interesting. So they can load up more if they want to.
Yeah. Yeah. All right. Should we leave that story there and we can move on to another story?
Yeah, I think so. I think that's about all I could possibly say about it.
Yeah. So
what do we got next?
Yeah. Where can we go? We got a quick one.
Oh, here we go. We can go to this next news story. I'll take it.
Yeah, go for it.
Australia. I mean, we knew this was coming, but it's now official. We are in a recession officially. For the first time in 29 years.
Ba-bow.
There you go. Well before we were born. What does a recession feel like? I don't know. Haven't been born through one. Haven't lived through one. So this is going off technical definition, 2 consecutive quarters of negative GDP growth. GDP, gross domestic product, basically what your nation produces. So Q1 was negative 0.3%. Q2 was negative 7%. Woo. Cop that. I know that's not the biggest number, but when it comes to GDP of an entire country, that is quite a big number.
It is.
It's quite a big number.
Sorry,
what were you going to say?
I was just going to say, considering the GDP normally goes up at 2-3%, something like that, to go down 7% to get back up to where we were previously is it's quite a lot. So if you think of it, think of it that way.
Yeah, for sure. So we got, I just compared I wanted to look at other parts of the world as well, compared our Q2 to the rest of the world's Q2. So ours was negative 7. Get this, United Kingdom, negative 20.4%. That's massive. That's absolutely big. Slaughtered. In France, negative 13.8, Italy, negative 12, Canada, negative 12, Germany, negative 9, United States, negative 9.5, Japan, negative 7.8, European Union, negative 11.7. So,
oh, right. So we're actually doing, relatively speaking, quite well.
Relatively speaking, we're not actually doing too bad. And I think a lot of that comes back down to the government just stepping in and trying to, I suppose a lot of it's down to the fact that most parts of Australia got on top of the virus, wink, wink, nudge, nudge, Victorians, but we got on top of it fairly quickly and most of Australia could continue on. And also one thing to point out is that what's going on in Victoria right now really didn't affect Q2 too much, that most of that's in Q3. And good old Frydenberg did say that it's important to note that these figures do not include the stage 4 restrictions brought in by the Victorian government in August. And he says this will weigh heavily on the September figures. So I think that, Australia was able to open up pretty well in Q2 and get us back on track, but now we might see something different in Q3.
Yeah, I mean, most of Australia's had very little to no cases, right? I think most states have...
in the grand scheme of things, you're exactly right.
Yeah, besides Victoria over the past month or month and a half or so. I mean, Australia just did very, very well in order to get on top of it, so...
Yeah, we should have gone for an elimination strategy like New Zealand, though. Far out.
Yeah.
We should have just got rid of it for good. Not just, cases are going down, open back up. But hey, that's hindsight. We didn't know what we were doing back then.
Yeah.
It's had no idea. Hindsight. Yeah. But hey, New Zealand have done well. I mean, wait, no, Donald Trump said that they had a massive outbreak of cases. They must be doing terrible.
Did he actually say that?
Yeah, didn't you hear that?
No.
No, he came out and he was given some speech and he was, trying to excuse how bad the coronavirus is in America. And he was saying, and, everyone's criticizing the United States, but then, you look at countries that were on top of it, look at New Zealand, just a huge breakout in cases, unbelievably large breakout in cases, and then they got 4 or 5? Yeah, I know.
Did he mistake Victoria, Australia with New Zealand?
Yeah, maybe. But that's, I don't know, it's so funny. But he didn't use, it's very interesting how he talks, how he lies, because he doesn't use any numbers. He just says it and hopes that people don't the majority of people that hear him just don't fact check him at all. They just kind of believe what he says. Because, I mean, I love Jacinda Ardern's reply to that when she got asked about it. And she was just like, it's not really a big outbreak when we're not particularly too worried about the 5 new cases in New Zealand. I'd be much more worried about the tens of thousands of new cases daily that America's having. So I was like, send a little jab in the other direction, Jacinda. Man, I love Jacinda Ardern. She's quality. She's good.
Yeah, I haven't...
I'd vote for her. In a heartbeat, I'd vote for her.
I haven't heard much. I haven't listened to her speak much, so I don't really know. But
she's just down to earth. She just doesn't speak like a politician. She just speaks
good.
like a normal person.
That's what you want.
Just, generally progressive, change for the better, fair, equal-minded.
Yeah, that's what you want.
Geez, imagine that in politics. Geez, that'd be something, wouldn't it?
Yeah, just to get a straight answer.
Yeah, that'd be... Yeah, that would be interesting. Anyway.
Have we got anything else for this story?
Yeah, I was just reading through. It said, just a little bit more flavor. Private demand, that is spending on things other than public resources like electricity and water, detracted a whopping 7.9 points from the GDP as households clamped down on budgets during the pandemic. Spending on services fell by 17.6%, with those in transport, vehicles, hotels, cafes and restaurants the hardest hit. As a result, the government's general net saving rate fell to an eye-watering minus 82.6 billion. Holy smokes. Reflected largely in the $55.5 billion worth of subsidy payments and reduced tax income as a result of COVID-19. Yeah. That's certainly a large bill that someone's going to have to pay.
Yeah. And speaking of who's going to pay, we've got another
Probably
story.
the rich.
That was my segue into our next news story. Come on, Brandon.
Yeah, true. Well, I mean, it probably is the rich. I mean, that's what happened. Isn't it after '08, the budget repair levy, that was just an extra tax on the rich?
Yeah.
No, redistribution of wealth. That's how Ray Dalio would say it, wouldn't he?
Yeah, that's pretty much what happens. I mean, when the economy is expanding and asset prices are going up, that disproportionately goes towards people who hold a high number of assets. And then when there's a crash, when there's blood on the streets or whatever, they usually go calling on those people who have all that money
pretty much
to help clean it up.
Pretty much. But yeah, I mean, it makes sense. Like, where else are you going to get the money? You're not going to tax people that are struggling even more. Tax people that still have it decently. But that's getting into a messy area. We're going to be debating for hours if we open that can of worms, aren't we?
Yeah, let's not go there.
Anyway,
so,
all right, let's move on. Sorry, I ruined your segue. You had this perfect segue going, and now I've just stepped in and just messed it up.
So excited! I was thinking of that segue for so long.
Oh, I'm sorry. I'm sorry.
No, but so the Australian government. I read an article that said the Australian government is looking into increasing the superannuation tax in order to help pay for all of that money that we just spoke about that was spent during the pandemic. So. There's not.
So this is the tax of when you put your money into super, what it gets taxed at.
That's a good...
I believe. Is that right? Because it's currently 15%. Or when your money is in super, the gains you make on that, what it's taxed at.
Yeah, I would have thought it was when you were withdrawing your super.
Maybe it is. I don't know. To be honest, I don't know much about super.
Yeah, I don't know either.
Anyway, superannuation tax.
Yes, so it's currently 15%. And basically this article said that if it's increased to 17.5%, then the average Australian would lose an extra $40,000, $40,509 to be exact, of extra tax money that they need to pay on their superannuation portfolio.
Yeah.
And the plan, or not the plan, but this article was suggesting that the government may be looking to increase this to 25%, in which the average Australian would lose $150,449 in extra taxes. So, yeah, I mean, it's a substantial increase to look at increasing it from 15% to 25%. Usually if they're going to increase taxes, they want to do it, a little bit at a time. Do 1%,
that's
2%.
A big chunk. Yeah, this would be when people put money into super. It wouldn't be when they take it out, because I just remember when you take out super, generally speaking, it's tax-free. It's not counted as taxable income.
Right, okay.
So yeah, that's why people can make those when you go and see a tax agent and you're close or you're just over a tax threshold, they say, oh, do you want to make an extra contribution to super? Because say if your marginal rate's 30% and you could put more money in, you could make a concessional contribution to super. That's going to be taxed at 15%. So there's a 15% tax saving there. But as that tax rate goes up and up and up, you lose out on more and more and more, which I think those numbers, what you said, would be like the long-term effect of having that tax be higher on the money going in. So it allows less money to end up going into your super account to get invested to compound over time. And over time, that would lose you 40,000 or 150,000 on those two different tax rates. I imagine that's what it's saying. But like I said, I'm no expert.
Sounds right to me, so we'll just go with it.
I think that's how it works.
And then the other thing that this article was talking about was that the government's also considering bringing forward the 2021 income tax cuts in order to provide some relief for workers. So that's interesting because, I mean, considering how much money they've just spent on all of this pandemic relief, you would think that they would need to raise taxes, at least on some of the brackets, in order to pay for these. They
probably will. They'll probably just mask it.
Yeah, true.
They'll talk about tax cuts and then in the background they'll add an extra tax or something.
Yeah, or they tax you somewhere else. like in super.
Yeah.
So
Exactly. Yeah, exactly right. Oh, no. You like, don't worry, super tax is going up,
Income
but
tax
hey,
cut, yeah.
income tax is going down. Wait, how much is income tax going down by? Oh,
0.5%.
0.01%. How much is super going up? Like 5-10%. Oh dear. Sneaky, but yeah. It'd be such a hard time to be working on tax policy because, you've got this whopping hole in your budget. You've got this massive debt that you've just taken on. You're collecting less tax revenue this year because, obviously, because people have been earning less this year, working less. You've given a lot of money away. You had to get that money from somewhere, so it's just you need to get more money out of people. Like everyone's going to have to chip in more to try and repair the old budget, but hard to figure out where that comes from, except it's probably just going to be the rich.
Tough time to be a politician. Usually they
Tough
can
time
just
to
kind
be
of,
someone that's filthy rich.
Yeah, true. Except not, because the stock market's at an all-time high. So.
Yeah, true. If you're heavily invested, it's a very nice time.
Yeah, it's interesting world. Interesting world where that can happen. Stock market's at an all-time high, and
it's just so bizarre, isn't it?
Most people barely hanging on to a job, or
it's crazy. It's just stock market doesn't quite reflect the economic reality, does it?
Wow, it's amazing. It's almost as if it's not quite efficient all the time.
Yeah, almost as though central banks are just keeping it inflated. Anyway, topic for another day, maybe.
Yeah.
Should we move on to some Q&A?
Yeah.
This has been a shorter podcast today. Maybe we'll do some more Q&A. Let's get stuck into some questions. What have people been asking?
Let's have a look. All right, I can pose this one to you. Should we just go from the top?
Go for it. Yep.
So,
work our way down.
Hi, lads. Question. Do shares compound even when they don't pay a dividend?
Yes, but not in the same way. So dividend, yes, you get paid your dividend yield. You can turn around and reinvest that dividend reinvestment plan, and that buys you more shares. And so your total investment is worth more. That's compounding through paying a dividend. A lot of companies do that. A lot of Australian companies do because they like to give fully franked dividends, which makes it even nicer for you as the shareholder. But if they don't pay a dividend, it just means that they are holding on to their cash. So they generate their cash flow for the year, then they pay, or they make their money, the company makes their money, then they pay their tax. And then after their tax, then they go, you know what are we going to do? We're just going to keep this money for ourselves. We're going to invest it. We're going to pay down debt. We're going to buy back stock, or we're going to pay a dividend. And they can choose to do, a whole range of different things with it. But a lot of times, especially fast growing, so like growth companies will tend to hold on to their money to reinvest it back in their own business. And if they do that, then you're still getting a compounding effect, but so it's just a direct compounding effect. The company's holding on to their cash. They are reinvesting it to grow their own business. So the compounding effect is within the business. So they'll open more stores, create more manufacturing lines, which will lead to an increase in sales, which will lead to an increase in cash flow. That makes the company more valuable. And because the company itself becomes more valuable, then the share price typically rises. So you get a compounding effect, not in dividends, but in capital growth.
Take a breath.
Is that about right?
My goodness, great answer. There's nothing else I'm going to add to that. It's brilliant.
Got him.
It's like you had that answer prepared. So
it is. I actually didn't, but it did sound like I had it prepared.
Good.
It sounded like I was reading something. I was just in the zone, right?
Yeah, you just had the flow.
Bang, bang, bang,
Nice.
bang. Ooh, hit me with another one. Here we go. All right, so you don't have anything to add to that one?
No, I don't think so. I think that was a great answer.
Thanks, mate. I appreciate that.
No worries.
I appreciate it. I'm not sure if we've answered this one. Have we answered this one? I don't think so.
I don't think so.
Maybe I'm just remembering wrong. We'll answer it again.
We'll go for it again.
If we've answered it already.
That's all right.
How do you know when you have... Oh, no, this is not the one I'm thinking about. How do you know when you have done enough research into a stock to make it a substantial position in your portfolio? Is there, say, a minimum number of hours of research? Or is it a case that, you just know when you know?
Yeah. I mean, I don't think there's any sort of set number of hours that I go through and then I'm like, aha, I know enough. Yeah, I mean, there's no clean answer to that at all. Sometimes you'll do a ton of research, you'll be really confident on an investment, and you still might have missed something. And sometimes maybe you have a pretty good understanding of a certain industry, so you don't actually need to do that much research. You do a few hours of research, and you're pretty confident. I mean, I don't really have a good answer for this, except that for the businesses that are big positions in my portfolio, I've done a lot of hours of research into them, many hours of research into them, usually over the course of at least a year. And any time a business there's only a couple in my portfolio that are above 10% in size, maybe 2 or 3 of them. And they're all businesses that I started researching well over a year, 2 years ago. One of them even close to 3 years ago. So there's just a very long, progressive, ongoing process of learning more and more about a business. And over that time, I become progressively more confident in my understanding. But there's no real, I guess, line in the sand where I suddenly know enough, I guess. Yeah, tricky question.
Yeah, it is a tricky question. I think one thing to kind of put your mind at ease is that you never know enough. Yeah. Like you never have that full understanding. I mean, unless you're the CEO of the company, but you're always learning more stuff. Like I'm sure there's stuff about your investments over the past 3 months that you've learned that you didn't know before.
Yeah.
So there's not like a point where you sit back and you go, "Yep, I've done it. I know it." I guess one thing to think about is, if you are thinking, if you go to your brokerage site and you put in, okay, I want to make this investment, and you start typing in the details, and maybe you put in $10,000 is what you're going to buy. If you feel nervous on that page, then you probably don't know your stock well enough. You probably haven't done enough research. I mean, if you log onto your brokerage account and you go, "Yep, I'm feeling good. I've done all this research. I've checked the management team. I know they're all good. I've done the valuation. I know they're good. They've got this great competitive advantage. I really understand the business. I've been following this business. I've been using their products. I know this. I can see the picture. I can see the growth into the future." And, you just log on and you put in $10,000 and you're feeling great about it, and you've double checked your valuations. Then you probably do know enough about it. Like you're probably pretty confident in your investment there. But if you're logging on, you're like, "Oh, Tesla stock. I've just looked at it over the past week because, man, it's gone up so much, and I don't want to miss out. One of my mates got into it, and he's making a lot of money. $20,000. Oh shit, should I buy? I really don't know." If it makes your stomach turn a little bit, then you just don't know enough about it, and you should probably research a little bit more.
Yeah.
And also, if you're struggling to sleep at night, if you've got a lot of money on the line and you are struggling to sleep at night because you're not sure about an investment, that is a good sign that you don't know it well enough.
Yeah, that's a good point. Definitely want to be able to sleep well at night.
Yeah.
There's no need to extend yourself over not being able to get a good night's sleep, or constantly worrying about when a stock's price is moving up and down. That's another thing. I think if one of my bigger positions goes down 5% or something, I'll get a lot of comments on YouTube asking me about it, but I don't even feel anything. It's just like, I don't care if it goes down 5%.
That's a good point. That's a really good point. If you have a large position and your stock goes down and you feel worried, then you probably don't know it well enough. But if you know it well enough, then if the stock goes down, you should get excited.
Yeah, pretty much. All right.
All right, let's go into this next one.
Yeah.
What's another one?
All right, so I'll read this one to you. It's a little bit of a long one.
All right, hit me.
Hey guys, great episode as always. I presume he's talking about the episode we're recording right now. So thank you very much.
Of course. Thank you. Thank you very much. I thought it was quite a good one. It's going well so far. It's 48 minutes in. How do you think it's going?
Yeah, it's going well. It's not over yet. So
it's going all right.
Yeah.
So I was a little bit worried. We were a bit quick through the news topics today, but Q&A is really padding it out. And me talking about a whole lot of nothing right now, we're padding it out, getting ever closer to that 1 hour mark. Yeah, I think it's going good. I think it's going to finish up well. Anyway.
We are so annoying.
Yeah. Sorry.
Anyway,
mate.
This question. I had a question about when you both choose to load up on your positions. For example, will you hold off on buying because you've already got a good return on a stock, or will you buy any more anyway based on your valuations if it is at a margin of safety price? You could have another method you use, but I was just keen to get your thoughts. Thanks heaps.
I'm not afraid to be a buyer as long as it's under that margin of safety price. Like if I got some company at I don't know, like a 60% margin of safety price, and I made a significant investment, and now it's only at a 50% margin of safety. Like I'm still going to buy if I can, if I've saved up a little bit more money. It's not like I'm going to be like, oh, that stock was at 60% margin of safety, and now it's at 50. I'm not going to buy it. Like if it was at like a 30% margin of safety, and then like I invested a sum of money, and now it's got no margin of safety, then I'd be like, nah, I pass. I'll find something else. But yeah, if it's undervalued, like I'll keep buying it. I'm sure there's like a specific rule on how undervalued is it and how much of your capital should you allocate to it. But I don't really follow that stuff. I just think I just buy slowly. Like if it hits margin of safety, I'll invest, maybe 10, 20, 30% of what I want to make a position out of. I'll invest that and then track it over time. How's it going? If it's still like come back in another month or two, how are we looking? Make another investment if it's still where it's at or if it's fallen further or whatever. And I think is that where the saying buy slow, sell fast comes from? I don't know.
Yeah, I think so. Yeah, I mean, I'm the same. I'm always going to be buying based on valuation, based on what I think the future cash flows will be for the business, or if you're using margin of safety method, where you think the price of that business's stock can be at some point in the future, probably 5 or 10 years down the road. So that's pretty much where I sit in terms of buying. And in terms of selling, I don't really plan on selling anything really. I mean, even if a stock might go up 30% in a few months and that looks like a good return for that year, but I have a much more longer view of that business. So I'm even if a stock goes up a substantial amount in the short term, most of the time I'll be holding onto it if it's a great business still, of course. Yeah,
sounds good. Here's our last question of the day.
All right.
Are we going to be having any more guests on the show? I don't know.
Good question.
I'm sure we will.
I mean, yes, at some point.
It's not like we hate everyone.
No, it's not like we're done. We've got a little checklist. Yep, we've had all the guests we want.
Yeah, we tick, 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 tick. Oh, no one left. No, I don't know. We should probably get some more. We haven't. Obviously, we had Jason on last week, but there was a period of time way back when where we were having like a guest every second week. We should try and get back into that. I think we should space them out a bit as well. So there's a bit of just us two talking about news, and then we have someone on maybe to talk about a topic in depth or something like that.
Yeah, I think more likely than not, when we do want to have more guests on regularly, maybe we'll spread them out. Or I guess we could do like a 1 month block where we just do, a few guests. We book in a few guests back to back. But yeah, we don't have any lined up right at the moment, but that might change in the near future.
I mean, if you want us to reach out to someone and get them on the podcast, or at least try to, then just let us know.
Yeah.
Just send us a comment on YouTube, or if you're someone that wants to come on, then feel free to send us an email or something like that, and we'll see.
Yeah, just keep commenting on Phil Town's YouTube videos, letting him know that he needs to come on the Young Investors podcast.
I think that's getting less and less likely, to be honest. It's kind of weird. I kind of feel like it's getting less likely, and I kind of feel like it's getting more likely, because as time goes on, we kind of gain more subscribers, and it kind of looks a little bit more, I don't know, maybe impressive. Maybe impressive's not the right word, but more established, I suppose. But at the same time, I mean, we've tried to reach out a few times to him, and it's never worked. We've gotten close a couple of times, but nothing that's really that was ever going to be concrete, I suppose.
Yeah, I mean, I don't see him doing many, just from like, I guess over the past year or whatever. I haven't really seen him do many collaborations on his podcast, or really any on his podcast or the YouTube channel, or really anywhere. So it seems like it's not just us. It seems like it's kind of
it's everyone.
Yeah, he doesn't really do that kind of thing.
Well, you remember when we got that message from, what was it, like his, I don't even know, his manager or something, and it was like, hey, if you ever come to the States, come to his 3-day course for free. And we were like, hell yeah, that sounds awesome. We'd be happy to come over to the States, but we just want to be able to lock in like some sort of collaboration with Phil, an interview, a podcast, a YouTube video. And then they went from being, come over, to being like, I'm sorry, we can't arrange that. So I feel like maybe Phil's just not maybe he prefers to play polo than talk to us plebs.
Fair enough.
Phil, if you're listening to this,
Please, Phil.
I want you to give up 1 week of polo and do a collaboration with the Young Investors Podcast.
You know what? We can keep playing. We can do it while we're playing polo as well.
Yeah,
like we don't have to stop.
I mean, I'm pretty bad at riding horses. Polo is the one where you ride.
Yeah,
a horse,
with
right?
the stick.
I'm sure that's the technical term. It's the one where you ride the horse and you hit the ball with the stick.
Yeah. That's the one. Yeah.
Do you like my new polo stick? No, but totally, Phil. I mean, we'll mic you up and we'll be mic'd up. We'll have little lapel mics. We'll be on our horses, hitting the polo ball back and forth. We'll do a couple of drills. We'll play some games. It'll be fantastic. And we'll even take you out to Chipotle. How does that sound? We'll take you out to Chipotle afterwards.
Let us know, please.
Do you reckon I got him with that?
I think so. Yeah, I think you got him.
It was the Chipotle, wasn't it?
Yeah, it's a Chipotle.
Yeah, cool. Yeah. All right. Well, I'm pretty sure we'll probably lock him in next week, won't we?
Yeah. So you can look forward to that, guys. We'll Phil Towns coming on the podcast.
Man, that would just imagine that. That would be crazy. Anyway.
Oh dear.
We're getting a bit rambly as we always do towards the end of an episode. It's 4:00 in the afternoon. God, that's just the time where you just want to take a nice afternoon nap.
It's about that time.
Which we might go and do right now. Anyway, guys, thanks very much for listening. Thanks for sending in your questions as always. Keep them coming. We need some more questions. So feel free if you've got a question on your mind. Can be about anything, really. Just send it in. And we'll add it to the list. We'll talk about it in the next week's Q&A session. Thanks always, Sharesight, for sponsoring. Thanks very much to you guys for listening too. Obviously, the podcast is nothing without you. We definitely appreciate the hour of your week that you give us each and every week. So, thank you very much as always for listening. Thanks, Hamish, as always.
Thank you.
And I think we'll wrap it up there. We'll see you guys next week.